Alright guys, so this is a supercut version of the best parts of my 2-hour-long discussion with my fellow mentors, Elson Chu and Bang Pham Van, which is, by the way, already live on the Piranha Profits YouTube channel. So if you want to watch the entire 2-hour discussion, do catch that on that channel. Now, we've shared exclusively on our upcoming expectations and opportunities we see in the markets today, so you wouldn't want to miss all this out. We have a lot more exciting content lined up for you leading up to the upcoming live event. So I can't wait to see you at Black Market, and I'm sure you're as excited as I am to pick up a lot more ideas and strategies. Click on the registration link down below to grab your free ticket right now.
Welcome to the exclusive premiere of the Black Market panel discussion by Piranha Profits. So I'm Chee Keng, the host for today, and I have with me here some of the best in their respective fields, regardless in investing, trading, stocks, options, or even crypto. So naturally, investors or traders are in one of two camps. Either you have a big enough interest in the markets already and thinking, is it time to take profits or wait for a pullback? Or on the other hand, you might be thinking, should you still be buying in an all-time high market?
We had this very same conversation in the last year panel discussion, and the same group of people are asking if we are in the bubble. In my opinion, I don't think so. I don't think we are in the bubble at all. In fact, I'm still bullish on the market, cautiously bullish, and I don't think we are in the bubble, right? Because I trade mostly on mega tech stock or mega cap stocks, which generate a lot of profits and also very strong cash flow. Now, valuation could be a concern for many people, but for me, I adapt different option trading strategies that could benefit from different setups and different market environment, which allows me to squeeze more profit out of on the market scenarios.
So there are many ways to measure valuation, and a lot of people, they like to look at PE ratio, the price to earnings ratio. And based on that, the market looks very expensive, okay? If you look at the forward PE ratio of the S&P, it's about 22 times earnings. And if you look at the last 10 years average, it's about 18 times. So it looks expensive based on that. But you have to be very careful because remember that PE ratio is very limited because it doesn't take into account the growth of the earnings, right? So yes, the PE ratio of the market today is high compared to the past 10, 20, 30 years. But also because companies today are growing their earnings much faster than companies grew their earnings 10, 20, 30 years ago. And margins are very different. Like for example, 30 years ago, the net profit margin of the average S&P 500 company was 5%. 5 to 6%, right? Today, the average net profit margin is 12%. So in the last 30 years, profit margins of companies have doubled. Okay, so that means companies are making more money today than they were 30 years ago, and their earnings are growing faster. So you can't really compare the PE today to 30 years ago. You have to always compare the price earnings, the PE, to the growth of the earnings, right? So if you take the PE ratio, divide by the growth of the earnings, you get what we call the PEG ratio, the PEG ratio. So that's a better measure of valuation. And if you look at the PEG ratio now, I think we can put up a chart on this, right? Currently, it is about 1.2 PEG ratio. And if you compare that to the dot-com bubble, at that time, the dot-com, it was 1.6 PEG ratio. And if you look at past market tops, it was about 1.6, 1.8. Now, if you look at Cisco at that time during the bubble, Cisco was selling at 130 times PE ratio. And the earnings growth was only 29%. So if you take the 130% PE, divide by 30% earnings growth, that gives you 4.5 PEG ratio. That is insane. Okay, so you would definitely have sold way before the bubble burst. But today, if you look at NVIDIA, the PE ratio, I believe it's about forward 30 to 40 times PE ratio, right? 40 times PE ratio. But NVIDIA's earnings is growing at 30 to 40%. So if you take a PE of 30 to 40 divided by the earnings growth of 30 to 40, the PEG ratio of NVIDIA is only slightly above 1. So that means NVIDIA is not that expensive based on that. It's not cheap, but it's not bubble expensive.
Okay, generally, what I learned based on my experience trading for many years is that a lot of traders thought that they shouldn't buy the high and they shouldn't sell the low. But based on my experience, actually, the markets always what's high actually goes higher. And I learned this when I was in the prop desk trading as well, that actually markets are strongest when you are buying and selling higher. Because that's when certain asset classes will do what we call a flush in no man's land. No man's land means there's no price action on the left side of the chart. The markets right now, I don't think that it is at the all-time high and it's going to come down. And as I mentioned earlier, it's still in a bull run with no signs of top. So how I position myself is 1/3 in different asset classes like US market, China-Hong Kong market, and 1/3 in the crypto market across the risk spectrum.
If you guys remember my outlook for this year, which I presented early this year, I did expect a double-digit return for S&P this year. So, so far, S&P up about 23%. I'm not completely surprised. It was quite aligned with the double-digit return I expected. My biggest wins this year was NVIDIA, up 191%. In terms of my actual profit gain is $264,000 US. But it could have been $500,000 if I didn't sell half my NVIDIA a few years back. So my wife would be slapping me hard by the end of this year, as always. She always slaps me when I do something stupid. My second best would be Meta. Although Meta is up 67% this year, but in terms of profit, it's up 178,000 US in my account. And again, I sold half my Meta because I sold covered calls, it was taken away, and this could have been 600,000, right? So again, wife going to slap me very hard again on that. Palantir has also done pretty well, but Palantir is a smaller position because it's more speculative, up 171% this year, but in terms of profit, it's only up 63,000 for my portfolio. Okay, so the global liquidity tells you how much money is in the global economy. And it goes through a cycle that normally lasts about a 4 to 5 year cycle where liquidity increases, liquidity goes down. So what affects this are the world central banks. So when central banks, they lower interest rates or they buy bonds, that increases money supply. If they increase interest rates or they sell bonds, that reduces money supply. So this money supply goes into a cycle. And in fact, in 2023, the money supply was actually falling a lot. But starting late or early 2024, the money supply has actually now been accelerating. And if you look at this chart over here, which we're going to show the chart right now, you can see that we are now at the early stages of the global liquidity cycle, which is now going up. Because all the central banks, not all, but many, like the US central bank is lowering interest rates, creating more money supply, Japan, China bazooka stimulus, as well as the ECB, European Central Bank. So all that is creating this liquidity that should support higher market prices. Now, having said that, remember that ultimately what makes the stock market go higher? Number one, earnings, right? So ultimately it is company generating higher profits that drives the market higher. So earnings, number one. Number two, share buybacks, when companies buy back shares. Number three, dividends. And number four, money supply. So many people think that it's only the money supply that makes the stock market go up. No. There are four things, okay? So if you look at 2023, money supply was dropping, but stocks still went up. Why? Because profits went up, share buybacks, dividends, okay? So what I'm saying is that now with money supply on an upswing, that gives additional support to stocks, but it's not the main support, yeah? Why I remain bullish, that I think that this bull market is still having room to run, is not just because of that, but number two, remember that we are still at the early stage of the AI revolution, which I've talked about now for more than 1.5 years. And this AI revolution, we also call it the sixth wave, is very much like what happened in the 1920s. If you remember in the 1920s, before we were alive, there was this huge economic growth and boom that, of course, eventually it lasted until 1929, okay? But what caused the 1920s, we call it the roaring 20s, was the innovation of automobiles, that people all started buying automobiles, and electrification. People started to learn how to use electricity, and that increased productivity. So today, the same thing is happening, except it's not the invention of electricity and automobiles, it is AI. It is robotics that is now creating tremendous productivity and earnings growth and profit margin growth for companies. And so far, since the start of this bull market, which is October 2022, S&P is up about 60%. Now, if you compare all the past bull markets, the average bull market is about 5.5 years. And the average bull market has made a gain of 180%. So if this is a normal bull market, that means we are only halfway, right? We still got another 2.5 years left to go. But I don't think this is a normal bull market. This is not a normal cyclical bull market. We are in what we call a secular long-term bull market. And again, if you look at this chart over here, you can see that if you look back at the last 100 years, secular bull markets last for 16 to 20 years. 16 to 20 years, right? And right now we are in the 12th year of the secular bull market, which again means we are only halfway, right? Or maybe three-quarter way, depending on what you look at it, in this secular bull market.
In fact, I have benefited tremendously from the favorite 5 stocks that I mentioned, and I use my DS Hammer tool to get the most out of it. I don't talk about the potential inflation coming back and hence could be a higher interest rate. That works in my favor because, you know, in many of my trades, I collect cash or the premium in advance, and that would earn me more interest, right? So it works in my favor in that context.
Since we are in a global liquidity environment, right, I'll call it the mother of all long, right? In this kind of scenario, I would want to position more into markets where along the risk premium curve, right, is much higher. For example, the China-Hong Kong market and the crypto market. But I will still be trading US markets. Let's say for the blue chips stocks in the S&P 500, I will still be risking, let's say, 1 to 2% for 2 to 4%, right, as a standard kind of trade. But what will really boost my portfolio, right, I believe for next year is to position myself more on the higher end of the risk premium curve, right, looking out for multi-bagger opportunities in the China-Hong Kong market, in the crypto market as well. I think the window opportunity to establish good position with good risk reward, right, is from now until end of the year and latest first half of next year. So I'll be looking at using the PEM price action manipulation bullish strategy. One of them which I'm going to cover in my live trading event, which is one of my favorite very potent strategy called the bullish 4-strike. And among others, there are others that I cover in my PEM course, like DR1, DR2, UC1, UC2 for uptrend continuation setup as well. So this will allow me to look out for technical opportunities in the US market and multi-bagger opportunities in the China-Hong Kong market and also the crypto market. And as I mentioned, I'll be looking at mainly for swing trading the weekly chart and the monthly chart. And it doesn't mean that their feedback will be long. Once you get in the good price with good risk reward, the potential could be huge, right? It could actually multi-bag by the first half of next year.
And so from my investment portfolio, again, I continue to add to my existing positions. So I always tell my students that the priority is to add more to your existing than to buy new ones, unless the new one is so compelling that it's so much stronger than the existing. All right, so I will be looking to add to my existing positions. And if you look at my portfolio, again, the majority of my existing positions are in the AI-related stocks, but the high-quality ones. Again, there are many low-quality AI stocks. I don't touch those. I touch the high-quality AI ones. And among these, some of them are already a bit too expensive. So I'm hoping that they could drop in the next few months. Again, I don't know when, but I'm hoping they could drop so I can accumulate more. Example would be NVIDIA. Right? I'm hoping NVIDIA could drop back down, Palantir could drop back down so I can add more of that. Then there are some of them that have really dropped, but not dropped as much. So Amazon, Google, for example, I think they are undervalued, but I'm still not adding because I already have a lot of them and I want them to drop more. Okay, so for these ones, what I do is I sell put options. I sell cash secured put options at a much lower level to collect premium. It's like being paid to wait for the stock to drop. So if the stock drops, I get assigned the shares. If the stock doesn't drop, I don't get the shares, but I get free money. So remember to join me in the Black Market Live online event for my investing webinar, where I'll talk about how to identify the top 1% of companies in the market and which are the ones I see with the most compelling opportunities in 2025. So click on the link in the description below to register and grab your free ticket.